Ladies and gentlemen, good day and welcome to the Aditya Birla Sun Life AMC Limited Q3 and 9 months FY22 earnings conference call. We have with us today from the management Mr. A. Subramaniam, Managing Director and CEO, Mr. Parag Joglekar, Chief Financial Officer, and Mr. Prakash Bhogle, Head Investor Relations. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the management address concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. I now hand the conference over to Mr. A. Subramaniam for his opening remarks. Thank you, and over to you, sir.
Yeah, thank you, operator, for the introduction. And good evening to everyone attending the investors call today. Wishing all a happy and prosperous and healthy New Year 2022. I hope you all had the opportunity to go through the earnings presentation. It's available on the stock exchange and our website. Let me first begin with the economic outlook and mutual fund industry update first, and then I'll go into details on our quarterly numbers output. The year 2022 is expected to see the emergence of global economic recovery, starting from the U.S. The recent spending on infrastructure development by U.S. is likely to boost the global spending towards capex, in turn fueling a global economic recovery. As you all know, central banks globally are all likely to undertake unwinding process of excess liquidity, at the same time prepare for a marginally higher interest rate regime on the back of economic growth and inflation coming back. While the emergence of new COVID-19 variants has created some fear factor the last 2 months, however, the impact of the third wave on business seems to be less, except for few sectors like tourism, hospitality, and mobility. Companies with stable growth and strong fundamentals have benefited from large investment avenues that is being planned. And further, the Government of India's thrust on spending on infrastructure has boosted investor sentiment and likely to provide a boost to industrial activities in the coming year. Add to that the PLI schemes of government also will, ideally speaking, would improve the overall manufacturing sectors, therefore increase the optimism towards industrial recovery to come back. During the quarter, the leading indices had a roller coaster ride, as we have seen as of yesterday as well. October saw the indices touching new high, and December indices correcting itself, which again something has been the trend for the last 2 months. This was, in our own belief, as an account of intensified selling pressure that has come from foreign portfolio investors across different sectors. However, the volatility was curtailed to a large extent as domestic investors' confidence and participation continued to act as a strong counterforce in the capital market, except the last 2 days of fall, which is different, probably one can say. It again appears going forward, the capital market movement may be influenced by factors such as union budget, which is around the corner, the results of election scheduled in 5 states, and central bank policy on interest rates, as well as unwinding process of the high liquidity. With respect to the mutual fund industry, during the quarter, average assets under management for the Indian mutual fund industry had an all-time high of 38 lakh crore size as on December 31, 2021, a growth of 6% as against 36 lakh crore as on September 30, 2021, and compared to the last year of December 31, 2020, the industry average assets grew by 29% from 29 lakh crore to 38 lakh crore size. The first 9 months of the fiscal 22, the mutual fund industry witnessed good inflows across various equity schemes. Significant proportion of these inflows have been contributed through launch of new schemes by various mutual funds across different categories, to the extent of about 87,900 crores have been raised under the NFO route. Retail participation from both T30 and B30 markets continued to remain strong during the same period to the existing funds as to new fund offerings. The continued promotion of SIPs has created a significant momentum in the monthly SIP contribution to the overall industry. In fact, the overall monthly SIP contribution has hit a record high of 11,300 crores by December 2021. The industry witnessed a strong net equity sales of rupees 71,900 crores in the Q3 FY22 through a new fund offerings as well as existing funds. This trend has consistently played out over the past few months due to the high liquidity, as well as industry's experience on mutual funds have been pretty good. Within the existing equity and equity schemes and hybrid categories, multiple multi-cap schemes, sectoral dynamic allocation schemes, these are we have been seeing the reasonably good inflows on the existing funds. As on December 31, 2021, the total number of mutual fund investors stood at 12 crore versus 9.5 crores as of December 30, 2020. Again, which is an increase of about 28% on a year-on-year basis. Retail investor surge is also reflected in higher industry individual assets under management, which again grew by 29% year-on-year and contributed about 58% of the total average asset management is coming from individual contributing to the overall assets. The overall mutual fund investments as on December 31, 2021 from B30 cities also was about 16.6% of the overall asset management. New SIP registration for about 19.54 million in FY22, which again gives the confidence for the future growth of industry. In fact, SIP as a way of investing have come back reasonably good in the last few months. The December alone, in the quarter alone, SIP count today stands about 4.9 crore accounts, contributes to about 4 years rather, contributes to overall SIP accounts. Coming to Aditya Sun Life AMC performance, our total average asset management for the quarter ending December 21 stood at 3,10,000 crores with a growth of about 16% year-on-year, mainly on the back of robust contribution from the equity segment of our business. However, our quarter-on-quarter total AUM growth has seen a dip due to marginal year-end outflows in few of our fixed income schemes, which has been the trend in even the past, and normally the money comes back as we move to the next quarter. Our equity mutual fund average AUM grew by 39% year-on-year to 1,22,000 crores for the quarter ending December 2021. Our equity mix is an all-time high of 41% for the last quarter. Customer acquisitions, as you all know, remains a key area of focus for us. We added close to about 9,80,000 new folios in the 9 months period of current calendar year, and with this overall folio has increased to 7.6 million from about 7 million customer base that we had when we went for the IPO. Over the last few years, our focus has been on growing our retail franchisee and increasing the wallet share from B30 cities. We are happy to share that our efforts have really worked well, with the contribution of retail franchisee increasing to 48% as on December 2021 compared to 41% 5 years ago in the total assets overall average asset management. Similarly, the contribution from B30 cities has grown to 16% as on December 2021 from 13% 5 years ago. Our equity performance has seen a significant turnaround across all categories. In fact, some of our funds like Dynamic Allocation Fund have seen a reasonably good growth this year, therefore leading to a net inflows coming in few schemes, which includes the Dynamic Allocation Fund. During the quarter, we launched ABSL Business Cycle Fund, wherein we mobilized close to about 2,300 crores. As part of our overall scale initiatives, our team has been consistently working towards leveraging the potential of our existing products, which has got high recall, which are now becoming part of the recommendation list of banking industry, and therefore looking at our building size, while of course looking at new launch of products, as and there is a gap, and also there is merit for investors to own them. In order to build a culture of sustainable growth in our AUM, we have conceptualized a theme called Har Ghar SIP. Under this concept, we have launched many digital initiatives under the Win with SIP campaign, which is gaining traction. This is also creating awareness about the multi-SIP I call it, feature that eases the process of investing in multiple schemes, as well as acts as an effective tool for goal-based investing. Our focus in building our monthly SIP contribution has further moved from 785 crores per month contribution to 892 crores per month for the December 2021. In fact, 88% of our SIPs registered have had a tenure of more than 5 years. At the same time, 79% of our SIP registered have got more than 10 years of tenure. In fact, during the quarter, we registered 3,24,000 new SIPs during the quarter ending December 21. In fact, which is the highest ever quarterly registration that we had in the last 3 years. As a result, we now have about 3.11 million live SIPs with us as of December 2021. In fact, the same number, just about 6 months back, were about 2.98 million customer base we had in live SIPs. We have seen a significant movement in terms of SAP folios count going up. As part of our endeavor to increase our presence in the T30 market, which is nothing but a build, operate and transfer model, continues to gain strength in setting up our emerging market presence. In addition to this, we also adopted the virtual relationship manager model, wherein the virtual manager will act as a single point contact for various servicing requirements, including selling our product. Under this model, we have activated around 1,200 distributors in the month of December 2021. In order to create higher mind recall, we also set up a separate service to sales model on an experimental basis. In fact, we did a pilot during the year. This exercise has given us a business insight to create the right impact which will help us in improving our NPS score and business expansion as well. Currently, we are on 25 plus dedicated personnel under this model. We hope to increase this as we start seeing the better implementation, better execution. In terms of building our alternate business, we have improved our product offering in alternate space. We have created a separate alternate business model to step up our focus in offering products in passives, PMS, and alternate investment fund. During the quarter, we have made decent progress in improving our product offering and also the size of this category. Our passive product offering has yielded good results, wherein our assets have gone up by more than 3 times from 1,692 crores as of March 2021 to 5,300 crores in December 2021. Our emphasis towards building passive strategy also gaining momentum by way of launch of more products through ETF, fund of funds, and multiple index funds. Our customer base in this category has now grown to around 210,000 folios, and that's again a big area of focus that we have as part of this product offering in order to have a complementary product in addition to actively managed funds. It is a significant improvement in our passive product category that we have witnessed in the quarter ending December 2021. As you may know, SEBI had allowed the launch of silver ETF akin to gold ETF in the mutual fund space. The month of January 2022, we launched the India's first silver ETF plus fund of fund combo in the industry. When I mean first, we actually launched silver ETF and fund of fund together. Therefore, we call it a plus. The other players also launched at the same time, whereas ours is a unique model to launch the product in together. Further, for ease of investors, we have bucketed our passive offerings into 4 categories oriented towards fixed income, equity, hybrid, and commodities. Under this guiding principle, we have planned a series of fund offerings on each of these buckets as we move forward. Under equity, we have already launched a few international funds with many more in the pipeline, which you will see it in the time to come. Through these launches, we aim to build our presence across passive category, which we can scale up in the future. We also plan to bundle these schemes under the FY model through a solution-based approach to cater the various investors' needs. Once we have gained traction and scale on our existing product, we plan to launch a smart beta passive product, which probably will have a comparatively higher margins and contribute to overall profitability. To cater the needs of large pool of NRIs and global investors, I am happy to inform all of you that we have received approval to offer portfolio management service from Gift City, Gandhinagar. This will help us to serve the growing needs of global investors who are keen to invest in India on one side through investment in dollar-based India funds. We'll also use this platform on the other side to create portfolios for Indian HNI investors under the liberalized remittance schemes of RBI up to $250,000 per annum. On the AIF front, the first and foremost, we are strengthening our fund management team further to offer products under the category 2 and category 3, equity and fixed income oriented product. On the real estate side, again the same AIF category, the fundraising category under 2 of real estate fund is underway, and I expect to close the first round very soon before March itself. We already have few commitment. Upon getting some more commitment, we will close the fund for subscriptions as the first launch in the month of before the month of March itself. Just moving on to the financials for the quarter, our focus continues to remain in achieving a robust asset mix of high margin assets of equity and long-term debt to improve revenue basis points to overall assets and management. We like to reiterate that our equity mix is an all-time high of 41% for the last quarter. During the third quarter, total revenue has improved by 10% year on year from rupees 321 crores to 353 crores. Our profit before tax has increased 28% year-on-year from 194 crores for quarter ending December 2020 to 249 crores for quarter ending December 2021. Excluding other income, core operating PBT for the quarter increased by 53% year-on-year from 150 crores to 230 crores. Is big achievement that we have done. In fact, this is the highest ever growth that we have got the last number of years. Our profit after tax has increased by 27% year-on-year from 146 crores to 186 crores. With respect to improving our cost efficiency and productivity, there is a reduction in cost to AUM basis points of around 3 basis points, excluding impact of overall employee incentives. Given the consistent dividend track record as we have established in the last quarter, after the last quarter results, we are able to maintain healthy ROE of 36.8% for the first 9 months of FY22, with the overall investments outstanding in the books currently about 1,980 crores. With this, I would like to conclude and open the floor for any questions that you may have.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Madhukar Ladda from Elara Capital. Please go ahead.
Hi, good evening and thank you for taking my question. So first, I wanted to understand, sir, on the equity side, I think our market share loss sort of continues. And what would, in your mind, be the main reason? Is it more because of performance, or are we losing market share in new flows? Second, sir, on this one-off in employee expenses, can you explain what this is? And I also see that there is a ESOP expense on the grant of about 12 crores, 11.7 crores. What was this number for the previous 2 quarters? And third, I see that the other income has dropped quite significantly in this quarter. Is there any one-off over there? Yeah, those would be my 3 questions. Yeah.
Sure. Yeah. Thanks, Madhukar, for asking the questions. Clearly, from the market share point of an equity, we have currently about 6.65. In fact, in the last, on a quarter-on-quarter basis, I think I would say the fall was generally lower than what we have been seeing as a trend in the last 1 year. I think as we have explained even in the past, broadly the market share loss is not because of our performance or any other activities. In fact, it's mainly because of the NFO opportunity which some of the market players have been utilizing it. As I mentioned in my talk, 89,000 crores of money was raised by NFOs, by players who did not have any presence in those segments. And second, of course, we have seen some bit of flows pick up in the existing funds, which have been having the momentum the last 1.5 years. These are the primary 2 reasons because of which we have seen the industry growing a little faster, and that's something had an impact on some of the existing AMCs, including ourselves. But having said that, we also did 2 NFOs in the current financial year, which is the latest one about the business cycle fund that we did, raised about 2,300 crores. But having said that, some of our existing funds have also seen inflows in the flexi cap category, as well as in the balance advantage fund which I mentioned about earlier. We have seen inflows in some of the existing categories. And there has been the significant focus that we are bringing in as we move forward in terms of building the size and existing funds which are relevant which remains one of the focus funds for even for distributors to sell as well as to the customers. That's something we are now reinforcing in terms of our sales productivity by even stepping up our focus on building our SAP. I think as you have seen, SAP has been gaining strength continuously, quarter on the quarter. In fact, as I speak, is close to 900 crores. Is something from a 780 now is improved to 900 crores, and those are something indication for the improving the overall equity contribution to the overall asset management. I think with respect to the EPOP, I'll just give it to Parag to take the question. Then I'll come back to the third question.
Yeah. So Madhukar, regarding the EPOP reversal which we have taken in this quarter, we have been running a cash scheme, as you might have seen in our earlier IPO presentation also, for all our employees, and that was our practice. In the post our listing, it is the management decision that the senior management and the key talent in the organization will be given the long-term incentive plan in the way of ESOP rather than the cash schemes to any these employees, and that is why post that view the management has decided to withdraw or close the earlier scheme, for which over the period we made some provision which are supposed to get paid out by next year end. So that provision we have reversed, because now our philosophy will be to pay employees through ESOPs.
Right.
On your other income point, there is no one-off hit in that. The other income, especially our main investment, are in debt funds and little bit investment of seed capital and some investment of other investment in equity funds. As you you might be aware that the debt scheme has given a very lower return because there was a rally earlier in 2 quarters, and that is why the income comparatively is down compared to the earlier quarters.
Understood. So just on the employee expenses again, so this 323 million, that is one-off which has come in this quarter. And then there is also a new incentive plan which is about 4.9 crores, around 5 crores of that. And then there is a ESOP expense grant of 12 crores roughly. So what were the numbers for the previous 2 quarters? Can you give that on a quarterly basis? What was that? And going forward, how will this number move?
ESOP, as we mentioned, that ESOP for earlier 2 quarters was in the range of around 24 odd crore. And this
that is total
which we have given is a payout to some of the key talent of the company, which we are planning to give in our over the next bonus cycle for these. And what was the other point you had?
So that number will be around 12 crores a quarter is what you said, right? For the previous 2 quarters.
ESOP. Yeah, ESOP.
Just to summarize, one, the employee incentive things, that's what you talked about, and some bit of thing purely on the base of performance-based incentive that we run for employees. To some extent, that has been the 4.9 crore that you mentioned about. It is for any potential reward that one has to give for some of the employees. That's something as provision has been made. With respect to the ESOP, which is anyway, which is a regular thing, which is currently for this quarter about 12 crores.
Right. And how would that number sort of shape up in, let's say, FY23 and 24? So what would the run rate be on a quarterly basis or an annual basis for the next couple of years? I just want to get a sense of how the employee line item would look like.
So Madhukar, on ESOP, as we mentioned earlier, that overall ESOP kitty will be in the range of around 130 odd crore. First year being the first year generally have, because it is 4-year kitty, so generally first year gets a higher expense in the first year. So first year will be slightly higher, maybe in the range of around 50 odd crore, 50 odd plus crore, and So that will keep on reducing going forward every year. Unless and until we come up with any new ESOP plan.
Yeah, so that has not changed. That 130 crore number over a 4-year period has not changed.
Yeah.
Okay. And so one final question. The yields have actually come down despite increase in the equity shares of the quarterly average AUM. So there's almost been a 650 basis point increase in equity share of quarterly average AUM, but overall sort of revenue yield is down. This would again be more because of the gross flows being higher. That would be the reason, right? I mean, most of this loss is in equity, I would suppose. Just to get a better sense, if you could throw some light on this.
So Madhukar, if you look at the overall operating revenue, actually has improved from 43.9 to 44.4. The overall total revenue bits has been down mainly due to the other income factor which get included in that.
No, I think even the my sheet sort of indicates that the quarterly. Okay, maybe. Yeah, I'll come back to you. Yeah.
If you look at the financial slide presentation, operating revenue to AUM basis points, we have shown improvement, 43.3 to 44.4. And whereas the total revenue which includes other income, you see the same.
No, sir, my bad.
Yeah, in fact, our revenue contribution on the equity has been getting better. Whereas the fixed income we could have seen contribution increasing, but for the flat growth in fixed income side.
Yes, sir.
Yeah.
Got it. Thank you. All the best, sir.
Yeah, thank you.
Thank you. Reminder to the participants, to ask a question, you may press star and 1. The next question is from the line of Prayesh Jain from Motilal Oswal. Please go ahead.
Yeah, good evening, sir. Just a few questions. Firstly, just extending the point on the yields part. So, in spite of such a sharp increase on the equity share, possibly the yield improvement does not match the same. So, is it fair to assume that the equity yield per se has been dropping? And if so, what is your outlook on the same? That would be my first question. Second, you mentioned we have around 12,000 crores of alternate assets. So what are the plans there? What kind of products we are planning to launch further in that category? And what is the profitability of that segment? And lastly, now that we have entered the ETF business and we have seen a couple of quarters, how remunerative is this business with regards to yields and profitability overall? That would be my 3 questions.
Which is the third question?
Sir, on the ETFs, how remunerative is this business now that we have experienced a couple of quarters? Yeah.
Yeah, I got it.
Yeah. So just to answer your first question, Prayesh, actually you have seen as we mentioned earlier, we have improved our overall fee bips from 43.9 to 44.4, mainly on the back of the equity market, equity composition in the overall AUM going up. That has helped. Equity as an overall contribution remain more or less in the same line because it will be slightly here and there, but it remain more or in same line. So there is no dip per se. On alternate asset, so more or less it is the high margin like PMS and AIF. It will be in the range of around 90 basis to 100 plus basis.
Yeah, I'll just answer that. Yeah, just to add to Parag mentioned the first question. Clearly, there is no dip per se. It's been more or less steady with respect to the equity contribution. And on the contrary, we keep continuously working towards where we can optimize our profitability, especially on any potential cost saving that we can bring on the distribution side, that we constantly look at, and that's something we do it. Generally, we see an opportunity to improve on this space, that we keep doing it on a quarter-on-quarter basis by few basis points. That has been one of the endeavors that we keep undertaking. That's anyway an ongoing process. With respect to alternate business, we have, of course, PMS is about 1,800 crores. We have launched one or two funds in this category, including in the opportunity fund that we have launched, which is more of the long-only nature. Broadly, this phase, the target would be about 90 basis points, kind of, as the Parag mentioned about. Of course, we also intend to launch product that could potentially have lower fees but higher fees in the form of profit sharing model. These are some of the product offerings that we are looking at creating as we move forward. And that's why I mentioned about in my initial briefing that we do look at, and we don't look for people who could also potentially run few of the specialized products in this category. That will run on the model which I just mentioned about. As far as the ETF concern, the first target is to create our presence. As I mentioned, the 4 categories in which we identified, we have been aggressively launching funds in order to create our presence. And then we position them in a manner that on the basis of these products, I can launch a fund of fund product that can fit into each of the funds, including funds that cater to the overseas investment opportunity. At the same time, some of the con-based product that we are looking at launching in the ETF probably will take about another 3 to 6 months period to launch product on a smart beta kind of product. There the contribution could be relatively higher. But otherwise, the contribution that we see in the ETF side, around 40 basis points roughly, that's what we target. Because we don't want to be there in every segment just for the sake of being there. At the same time, fund of fund that we're also looking at launching as it starts gaining momentum, given the fact that fund of fund would have some bit of higher ability to charge fees, that's something we'll build on top of that. So that's the model in which we are building the entire passive category.
Okay. So just on the PMS and the AIF side, I wanted to extend that part a bit. So when we say it's around 90 bits, as compared to a mutual fund business wherein the bits are net of scheme expenses, which sit on on the scheme accounts, but the PMS and AIF, all the expenses will be sitting in our P&L. So is it so this 90 bits will be net of marketing, or it will be gross, and then possibly at the EBITDA level it will be around 40-50 bits?
No, net of what you call distribution expenses. That's the way I think the PMS is done. Even the mutual fund also.
So,
it's a net of distribution expenses.
So Prayesh, in PMS generally the expense or the fee, the chargeability will be in the range of around 2% plus, and we pay maybe average in the range of 60 odd basis, 60 odd percent.
Okay. Okay.
We generate around that range.
Yeah.
Okay. Get that. Thank you so much for all that.
Yeah.
Thank you. The next question is from the line of Devjot Singh from Citigroup. Please go ahead.
Yeah, hi. Thank you for the opportunity. Sir, I had one question. So is there some constraint on the Birla Group companies to invest in our schemes? And if it's possible for you to quantify the size of such investments? Thank you.
See, Birla Group companies, from investment point of view, there are another investors who choose to invest in various places, right? That's the way each individual companies will operate. There's no constraint, I can call it. They'll go by their individual companies' policies. Each one of them are listed companies. They'll have their policy, and they'll have a way of investing in various securities. Definitely, of course, we being part of the same group, we will have some preferences over others in terms of getting a little higher market share, which you can call it. But again, each of the companies, having been part of the group for long, I know each one of them have got their individual policies on the basis of which they will, of course, give it to everyone. On the contrary, maybe I could have expected, like many other competition does it, to give 100% money to their own associate firms. In our case, they are very fair in terms of distributing to everyone, and we of course get our due deserving market share.
Okay, sir. Got it. That was my only question. Thank you.
Thank you. Ladies and gentlemen, to ask a question, please press star and one now. The next question is from the line of Sahej Mittal from HDFC Securities. Please go ahead.
Yeah, hi. Good evening, sir. Yeah, so my first question was around, so we have been talking quite a lot in the past 2 to 3 quarters that we have been focusing on hub and spokes model. This being a low-cost model. So what is the sort of traction we are getting from this channel, and where does this sit on the distribution mix which we disclose? One question was around, so hopping back on one of the questions raised earlier was around the employee cost. So on a steady state basis for, say, FY23, the employee cost should be in the range of 300 odd crores. Is that a fair assumption?
Yeah, with respect to your first question, Sahej, the hub and spoke model, the way we have defined the hub and spoke model is every location where we have a physical branch location can easily cover certain kilometers distance, the radius rather, on all the sides. That's the way we have defined the hub and spoke model, the way MNC companies operate. In fact, that created a reasonably good success in terms of setting the KRA for every branch manager, and also define very clearly the areas of coverage under him, both in terms of servicing customers as well as distributors. That remains one of the culture of every branch to improve their productivity. But of course, there is a huge scope for market share to improve everywhere. And that's something has been one of the big area of focus for us. In fact, what we also do is in each of the location and the hub and spoke location we identified, we actually monitor each location contribution to our overall success compared to the competition, and then make those individuals responsible for those branch hub and spoke location places, remain them continuously as to what the scope that they have on the base of it, how they can improve the overall contribution coming to the market, both in equity and other asset classes. As far as the employees cost concern, what is the employee cost?
So Sahej, on the employee cost, looking at the current run rate, it will be somewhere in the range of 300. Should be in the range of around 300. But there may be some recruitment as we are trying to build our alternate asset and all that stuff. So, but should be around that number only, somewhere.
And on a sequential basis, I see some dip on the admin expenses. So is that largely on account of the NSO expenses which we incurred in 2Q, which we did not incur in this quarter, or are there any other cost synergies playing out?
Correct.
Okay, that was all from my side.
Yeah.
Thank you, everyone.
Yeah, thank you.
Thank you. The next question is from the line of Anuj Singla from Bank of America. Please go ahead.
Yeah, thank you very much for the opportunity. So Bala sir, first question is on the new the NFO where we raised 2,300 crores. Can you talk about the distributor commissions? How much we have paid there, and what is the key net fee margins we should be expecting there? The second thing there is market feedback suggests obviously distribution commissions have been very high. New NFOs, like you also mentioned, have been one of the key drivers of new inflows. And this is leading to loss of market share, so some of the key players, including ourselves. How do we manage the dynamics between growth and profitability? What is our view there? Have we taken a conscious call that we will sit out of this because of the competitive intensity being very high, and we are okay with that market share loss? And third, can you give us an update on the upsell and cross-sell, within Aditya Birla AMC as well as the group entities? Thank you.
Yeah. So Anil, with respect to your first question on this NFO, clearly generally the policy that we have is first year generally we give about 80 to 85% of the earnings generally we give out, and then try and actually bring it down to 65 to or 70 to 30 kind of ratio on new funds over a period of next 3 years. 65 to 35 or maybe 70 to 30. That is the way we actually do the pricing when it comes to the new NFO offerings. And at the same time, even this time too, when we were doing this business cycle fund, we were easily collected about 5,000 crores. Had we paid more cost, incurred more cost, which some of the industry players may be doing it, but we didn't want to do it consciously. At the end of the day, getting money at the reasonably right cost is very important in building longer term profitability. That's something consciously we have taken the call. And with respect to NFOs, the way we do, Anil, is we of course do as a fund house. If you look at historically, we have been launching thematic funds. We have about 23% of our assets and management today is coming from thematic category. And wherever we see an opportunity in thematic category, we will launch funds if there is a merit for that to have. And again, as I mentioned, within the overall pricing structure that I mentioned about it, it of course definitely helps in increasing the customer base on one side. But otherwise, the broad plan that we have, 60 to 65% of the inflows should come through the existing funds, and 20 to 30% of the inflows can come to NFO launches if there is a scope. But otherwise, building existing funds to larger size is something we feel there is a huge merit given the fact that we have reasonably good long-term investment track record and products where part of the earlier channels on an ongoing basis in their selling recommendation. That's something we see it coming back. At the same time, SIPs that we have built, that once currently we have about close to 900 crores SIP subscription that we have, that is a significant emphasis that we are giving on this number has to keep going up on a month basis. And those SIPs inflows will come largely into the existing funds only. And that way we see it, and that's something will remain one of the focus area. With respect to the cross-sell ourselves, please, that's anyway, it's an ongoing exercise that we do as we see and the opportunity exists both within the ANC for selling to the existing customer. That's why the multi-SIP that I talked about is more intended towards increasing our customer ownership among various funds that we have. At the same time, Birla capital opportunities, that's something again we keep reviewing it as to how we can build within the regulatory framework in which we can operate. At the same time, build size. We have seeing some success in that. That in my own belief is will remain a continuous big area of focus in addition to the broader level push that we are giving in growing our market share.
Got it, sir. So just to clarify, when you mentioned about the commissions, you said first year we want a 65-35 split, 35 for the commissions, and they should go. You try to get it down to 70-30. Is that the right numbers?
No. First year would be high. Basically, the falling. It's basically the glide path would be as we go to the longer period, it goes down. First year would be more like 80 to 85% kind of sharing. Second year will come down to about say 80, and third year will come down to 70. Eventually, if you look at on a 3-year basis, it will come to about 75, 25, and then subsequent year will further improve. See, what we normally do on this kind of NFOs, Anil, and given the fact that general expectation from a few channel partners, including banking channel partners, we do have a high expectation in the first year, given the fact that all of us are moved to the trial model. At the same time, what is in our hand is actually what is the kind of size that we can take in this kind of model. Right? That's something we also don't encourage buying huge amount of assets at no profit kind of things. That's something we are quite conscious. And the base of this model, if you see, and over a period of next 3 years or maybe a 4-year cycle, will converge into the formula that I just mentioned.
Got it. And lastly, sir, can you talk about any major product gaps in the product portfolio which you will like to address over the next 12 months or so?
In terms of existing products,
apart from ETFs,
we constantly review, Anil, and as it stands today, not much scope seems to be there in the existing equity fund. At the same time, we see some opportunity in the fixed income space, but as the interest rates start rising this year, and we have already launched a new product in the form of what we call the index funds, in the debt index funds that we are now doing continuously, and we'll also see an opportunity this year to revive our fund offering in the credit side, that could potentially pick up as we move in the second of the financial year. At the same time, the balance as a category, I will probably see some scope in terms of launching one fund, though at this point of time we don't intend to launch it. But there is some scope on a 50-50 balance fund as a category. If there is a merit, then we will probably go for it. But otherwise, the category-wise where we intend to improve our size, the large cap, flexi cap, and large and mid cap, and the three and the diversity equity funds, and balance as a category, we also will see some merit for it to increase further.
Got it, sir. Got it. Thank you very much.
Yeah, thanks, Anuj.
Thank you. Participants, to ask a question, you may press star and 1. The next question is from the line of Shubhranshu Mishra from Systematics. Please go ahead.
Good evening, sir. Thank you for the opportunity. I was just looking at our distribution mixes, and I believe we've got a lot of vintage in our equity funds, equity schemes that we run. However, we still banks are like only 13% of our distribution mix. So I just wanted to understand why is it so low. I understand that we are going deeper into the geography and you want to build it through MFDs, which is slightly more secure than banks. So that's the first question. Second, I also wanted to understand banks as a distribution channel, sir. Do you think that they are coming off the pedestal they were earlier before we turned into trail-based, and now we can manage our AUM growth with or without banks as such? Even if this goes to maybe single digits, we can still show decent AUM growth in equity especially.
Yeah. So much of the way we operate is, all channels are important. I don't think we can say that one channel is not important versus others. Given our brand and vintage that we have, given the credibility as a fund house that we do enjoy in the industry, and all the channel partners, including banks, national distributors, PSU banks, digital partners, and IFAs, remain are the key partners for us. And given the fact that we don't have bank as a sponsor, we don't want to see that as a weakness, given the strength that we have established over a period of time, which we again mentioned during the IPO call as well. That's something we would continue to keep as a strength for us in building our relationship with the banking channel. So the banking channel is of two kinds. One is the PSU banking channels. Within the PSUs, leave aside State Bank of India, who does not sell any other funds other than their own fund. All other category, whether it is BOB, other banking channels, we are one of the major partners enjoying high market share, though volume is less, but we are the major partner for them. The same way, the leading banks who are large distribution network in India, such as HDFC Bank, Axis Bank, and other foreign banks, we do have reasonably good relationship and do enjoy good market share. But of course, all of them will go by the fund's recommendation in their list. That can keep varying from time to time. But otherwise, we have been consistently engaging with these channel partners to improve our contribution through their channels. In fact, during the quarter, our contribution coming from the banking channels and organized channels improved by almost about 40 basis points. So that will remain. See, IFAs and MFDs, we do have a special engagement and special focus by way of Privilege Club offering that we have talked about in the past. So that remains one of the key area of focus in building that. The last, of course, is the digital partners. We have, of course, tied up with all the 70 digital partners, including RIAs, and that's something today we have roughly about 6.5% market share. This again comes on the back of one, some of the products are part of the recommendation list, and some of them are actually being sold as distributors and which MFDs. That's something again will remain one of the big area of focus. So therefore, for all the channels, there is no question of we'll work only with some and not work with some. And for us, any increment share that come from any channel partners, as long as we are able to engage with them to their satisfaction, at the same time deliver our performance and other engagement activities with them to their satisfaction, I think we are fine with that.
Sure, sir. And if I can just squeeze in 2 data point questions, sir. First is that what do the top 1,000 MFDs contribute to in terms of equity sourcing? Second is what was the equity net flow and the MTM in the third quarter gone by?
Yeah, I think Subhanu, generally these numbers are not available, but otherwise I can give you mota the net inflows in equity schemes for the current financial year would be in the range of about roughly about 6,000 crores roughly. I think from April date.
No, Subhanshu, we don't give these numbers on the net flows and the gross flows of the schemes.
Net flows for equities for us, we don't disclose.
So as a asset class also, we don't give those numbers specifically.
Okay, sure. If you can at least tell us qualitatively whether it was...
I can only tell you, Subhanshu.
Right.
I can only tell you, Subhanshu, one has been improving in terms of net sales. But the other way also we measure is the gross sales number in which we also measure our success. There also have seen significant uptick even the gross sales, which generally is an indication of one, funds are being recommended and bought, and then which now is gradually converted into net sales as well. Again, SIP number which I talked about, continuous growth. So all of them will lead to a net sales improvement on a continuous basis.
Sure, sir. And the last question I asked is the concentration of the top 1,000 or 500 MFD.
Subhanshu, we don't have this data right now.
Right. Sure, sir. Thank you so much. Best of luck.
Thank you. Participants who wishes to ask a question, please press star and 1. The next question is from the line of Dipanjan Ghosh from Kotak. Please go ahead.
Hi, good evening, sir. Just one question from my side. If some of your competitors have been mentioning sharp pickup in some of this fintech or digital channels in terms of origination. So just wanted to get some qualitative perspective into your flow share or how you're seeing traction in those channels, and also kind of trying to understand the customer journey. How does it differ between the erstwhile distributor-led channel versus the direct channel? What are the key parameters probably your customer is looking at in some of these channels? Secondly, just in relation to this same question, if I were to look into your active equity market share for the retail plus HNI segment and maybe strip it into distributor-led versus direct channel, one would probably say that the market share losses from 2018 onwards have been much more steep in the direct channel versus the distributor-led channel. So how would you kind of want to address that question out here? That's all. Thanks.
Yeah. See, with respect to your first question on digital, the total assets under management coming from digital distribution channel is roughly about 75,000 crores. They have moved from 40,000 crores to 41,000 crores the last 1 year. And we as the fund house, they have close to roughly about 6,000 crores coming from this segment. Again, is the pure and the Aditya mentioned about earlier, roughly about 7% market share that we have in the digital partner. Definitely, the digital partners in terms of size, in terms of AUM size may not be very large. Definitely, they have been focusing on building customer base with 500 rupees, 100 rupees, 1,000 rupees kind of things. So that's something we as the fund house have been participating at least in the lead at digital partners that we have, whether it is PhonePe or Zerodha or Grow App or Kuvera or ET Money. So all these platforms we do. These are the people who have they took the name. They are the large players, including Paytm. They're the large players. Then all others are relatively small in size, but however they remain one of the platform in which we engage with. So that's something what industry is saying is true from the point of view of gaining traction, but in terms of value may not be very large, but definitely in terms of volume in the form of customer addition, they are reasonably good. With respect to your direct channel question, clearly I think direct channel is actually a combination of two things. One, institutional segment direct channel, HNIs and any direct customer comes in. In fact, we do have reasonably good connect with respect to the direct channel customers on the institutional space, including the people who put money in equity as well. And that's something we have reasonably good traction. The service to sales RM that I talked about is also more intended to increase our mind recall from the direct customers, and therefore the contribution could also go up. This is something is remains one area of opportunities. And some of the things that we are seeing, the growth that we are seeing, that is largely on account of shift that we saw about 3 years back, especially in the fixed income space. That is where we saw some dip in market share for us, given the fact that some of the funds we used to enjoy very high market share from HNIs in 3 categories of our funds, which are the leader in the industry, and post credit market and also interest rate volatility, those assets had lost some bit of size, which in my own belief is will probably start regaining within the fixed income space as I mentioned earlier, interest rates start moving up a little bit. I see an opportunity to build a size in that space. But on the equity side, is in a continuous exercise in building our direct channel for it to contribute.
Sure. Thank you, and that's all from my side. Thanks. All the best.
Thank you. The next question is from the line of Praveen Kumar from ICICI Securities. Please go ahead.
Yeah. Hi, sir. Am I audible enough?
Yes,
yeah. Hi. Sir, I just wanted your view on first thing that was that if any sector thematic funds, if we see any value over there, and there is some of the players from some of the peers who have already launched it. Is there kind of a first mover advantage over there? That remaining kind of remaining EMCs don't get lion share over there. Anecdotally, have you seen any kind of such data?
We keep doing that. See whether we have any opportunity to have the first mover advantage. But in fact, we being another fund, been there for long. I think we have presence in every category as possible. And in fact, I must tell you, the PSU fund that we saw last year, we saw significant growth in our PSU fund. When we saw an opportunity in the pure PSU fund in terms of value investing principle and deep value investing, and we not only got good assets in that space, we could also, of course, showcase the performance that has come in the segment field on the base of the first mover advantage may not necessarily come in the form of increase in price. The first mover advantage could also come in the form of giving a call on certain segment of the market little ahead of time. In fact, that as a fund house have been doing it continuously, whether it is the banking and financial services fund or the digital India fund, which also has seen reasonably good inflows in thematic category. In addition to the edge that we have in running both the MNC fund and Gen X fund, and both of them have got a longer term, the vintage on the base of it. General recall is also good, and that's something again we take it to our advantage in terms of pushing our strength on this product by showcasing. It may not necessarily this will give us the big AUM growth, but definitely it will give us the credibility that we can establish on these kind of funds route.
Sure, sir. That was helpful. Sir, just wanted to confirm the last question which you answered regarding market share loss in the direct channel. Was this purely because of the debt market crisis which happened?
Yes, that I still see there are certain categories we used to enjoy almost about 13 to 14% of market share. I remember a dynamic bond fund, but the largest fund in the category, even some of my competition used to be envy of us as to how we have built such a large size. And I think when interest rate volatility is set in, these are some of the areas we lost some market shares. That of course we have been regaining, though it's too far. I think it was the past, but that's something moved away post 2019. That's something we see it. Of course we keep saying it and then see how we can get that back. Well, we have seen some progress in terms of those money coming back as well.
Sure, sir. And sir, what is your view on the alternative side? So in one of the Concall, we had given our view how we need to grow that part of the business which is high profitability. So sir, what are the new initiatives which are being considered right now to increase that traction?
Yeah. So that of course, as I briefed earlier, on the PMS side, now we after seeing a size of about 5,000 crores, now back to about 1,800 crores, 1,850 crores, we launched new funds in the same category. We're also looking at launching one or two corn-based funds in this space. That's something again we'll launch in order to improve our product offering. And third is the real estate side. As I mentioned, we already launched real estate fund with the BGO, which is 100% subsidiary of Sun Life. Once we complete our first closing in India on the real estate debt-oriented real estate fund, where we intend to close it somewhere around 300 crores kind of size once we get the full commitment. Post that, we'll take this product to the overseas investors with the help of BGO and go on a roadshow, and that fund closure will happen over the next 6 months' time. That's the plan that we have. The same way on the alternate side, in addition to real estate, we do have currently looking at launching both the REIT and InvIT kind of fund. In order to make some of the more successful, we're also now briefing up the team. Currently, we have about 6-member team on the PMS side. Real estate side, we have a 4-member team. And in order to offer our product offering on the corn-based fund, we are actually looking at, we have been seeing a lot of people, and hopefully some of them will actually come on board. And lastly, of course, if there is an opportunity for any individual who's been running a boutique firm, would like to associate themselves with a bigger fund house like us, we'll probably look at that also as an opportunity as we see it coming in our way.
Thank you. The next question is from the line of Madhu Gupta from Quantum Asset Management. Please go ahead.
Good evening. Thanks for the opportunity. A few questions from my side. One is, what is the time frame for achieving the 25% minimum shareholding that is required as per SEBI? That's first question. The second question is, of the total mutual fund AUM, what share would be that invested by Birla Group companies? The third question is, as of now, the total investment by the AMC in its own mutual fund schemes is around 19.8 billion. And in your earlier comments, you said a part of it is seed capital and also equity. But given that SEBI has now increased the investment that AMCs have to make in their own mutual fund schemes, do you see that there will be, you'll have to invest more into your own mutual fund scheme because of that regulation which is going to come into effect? So those are the three questions from my side.
Yeah. So with respect to the associate companies, I'll call it associate company anyway. As per the SEBI, these numbers have to be disclosed in the AMFI website as well, which is somewhere in the range of about 9,000 crores in the overall 3 lakh crore size. And with respect to your second question on the
what is the time frame to achieve the 25% minimum public shareholding?
There's a 3-year time frame is there, Madhu. I think there is a 3-year time frame. Yeah.
So that target, it's not targeted as of now. When that?
Yeah, it's not targeted as of now. Yeah.
Oh, and the third question was on will there be an increase in the investment in your own mutual fund scheme because of that new regulation by SEBI, where in the high risk tier schemes, the mutual fund houses have to invest more. So do you see an increase in investment in your own schemes because of that implementation of that new rule by SEBI?
Yeah. If it comes as, of course, SEBI regulation and then the proposed an increase in seed capital, yes, that will have to happen. We don't have a choice. At the same time, whenever we launch a new product in the AIF category, again, there's a mandatory requirement to put some seed capital from the shareholders' money. That again will consider. And on top of it, again, we have to run a model portfolio in order to create a track record of investment. Therefore, that helps in building the future growth of the assets. We don't mind doing that as well. So that's again something option that we have kept it open for us.
So do you see a big increase in the investment in your mutual funds because of that SEBI rule? Right now it is 19.8 billion.
The total surplus that we have about 2,000 crores.
Right.
Out of which, I think we have been managing this conservatively through the fixed income and through the fixed income schemes. The mandatory investment that we have in equity, that will be about 50 crores.
Thank you. The next question is from the line of Prayesh Jain from Motilal Oswal. Please go ahead.
Yeah. So just, on the debt segment, we've seen a large outflows in this, on net basis, we've seen large outflows in this year. So, first of all, what are the reasons for such large outflows for the industry I'm talking about? And and what is the trend going ahead? What is the trend that you would expect going ahead? And secondly, on the alternate assets, earlier I remember you were talking about growing this 12,000 odd crores to 50,000 odd crores in 2 to 3 years time frame. Is that still holds true? And do we still aim to achieve that kind of a number in next 2 to 3 years?
Yeah. Thanks, Prayesh. On your first question on fixed income outflows, largely due to the most of the money managers have been running the portfolios with the low duration kind of things, giving somewhere around 3.5 to 4% kind of range. Therefore, to some extent, some of the people otherwise have been investing in mutual funds would also gone to the bond market buying directly. That's why if you look at even the overall size, the fixed income size has now become a little lower than even equity to some extent. I think that's actually largely the function of RBI when they reverse the process of unwinding through multiple VRR schemes, and that has been the primary cause of outflow. And then on the HNIs and individuals point of view, I think primarily coming into the fixed income schemes at low interest rates cannot be that much attractive. Therefore, money is moving either to the arbitrage fund or to the balance fund as a category. With respect to alternate business, of course, as we move forward this year with the 10-year bond yields ranging between 650 to 660, we already launched debt index funds equivalent for multiple tenors, other return kind of fund. We see some bit of momentum coming in this phase. We'll probably continue to offer that till such time we are able to offer product the actually managed debt funds where we see an opportunity. If there is a merit, then we will start focusing on that as we see right opportunity comes, both on the credit related funds as well as on the duration funds. With respect to alternate investment fund, what you mentioned about, yes, the broader aspiration remains in order to build our product offering, differential product offering for growing HNI needs and family offices, as well as pension funds globally who are investing in India, and that's something remains. Offshore building business, we already have about 9,000 crores of size. The offshore last 3 years we have seen more or less static kind of growth, and despite having been managing money for last 14 years to a sovereign wealth fund and delivered one of the best possible return to the investors, and we not got any additional inflows on those funds, and probably we'll also see a similar mandate being pursued in the next few years. Therefore, the broader vision aspiration that we have that holds good even today, and any step that we are taking with respect to the beefing of the team, all of them actually in the direction of building the size in this space.
All right. Thank you so much, sir, and all the best, sir.
Yeah. Thanks, Suresh.
Thank you. Ladies and gentlemen, this was the last question for today. I would now like to hand the conference over to Mr. A. Balasubramanian, MD and CEO, for closing comments.
Yeah. Thank you, everyone, for the wonderful interactions and questions that you all asked. Thank you very much, ladies and gentlemen, for tuning in. And with this, we conclude our Q3 FY22 earnings call. Do feel free to reach out in case of any unanswered questions. You can get in touch with our IR head, Mr. Prakash Bogle. And stay safe and stay healthy. Thank you.
Thank you. On behalf of Aditya Birla Sun Life AMC Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you.